As of 2018, Canada had over 1 million millionaires. Crazier still is that number is expected to nearly double by 2023, which is just 3 short years from when I'm filming this video. And if that's a fact that doesn't shock you, then you're probably already one of those millionaires. But if it does shock you, let me let you in on a little bit of a secret here, a little bit of an open secret. Most of these net worth millionaires, all of their money is tied up in real estate, or the majority of their money is tied up in real estate. They didn't get that way through stocks. They didn't get that way through saving and penny pinching. They got that way through investing in real estate. And I'm gonna hop over to my PC and kind of show you the numbers and how this all works. So like I was saying, the number of Canadian millionaires will jump by more than half in the next 5 years. So currently we've got 1.3 million millionaires, or as of 2018 rather. It's expected to increase by 54% to nearly 2 million by 2023. To give you an idea of how most of these people's wealth is comprised, here's the median asset holdings for economic families in Canada. This is the 2016 census. It would have changed a little bit by now, but overwhelmingly it's probably pretty accurate, except for the actual values of each individual investment. So most Canadians have most of their net worth derived from their primary real estate, meaning the house that they actually live in, that they or their family actually lives in. Secondary, the second biggest chunk would be investment real estate. And now not everyone has an investment property, so there's a much higher percentage of people who own the home that they live in than a percentage of people who actually own investment properties. So that's why you're seeing the discrepancy in value. And then obviously you have your pension making up the third largest chunk, and then things like your RRSP and stocks. The average Canadian only has about $30,000 in stocks, so most of these millionaires are not, it's not from trading the stock market. And once you deduct mortgage debt, right, because this doesn't show the actual debt, we end up with the average, economic family's net worth being somewhere around $600,000. So Canadian real estate, I want to give you an idea of the cumulative overall picture. So real estate in Canada is worth 4.8 trillion, meaning all of the homes in Canada added up roughly $4.8 trillion worth. And it's doubled in 10 years, which makes sense. It sounds crazy it sounds crazy at first glance, but it makes sense when you think of it, that the doubles every 8 to 10 years is an adage it's a saying that's been around in real estate for a long, long time. I just want to give you an idea though. That means that if you're not in the real estate market, you missed out on your share of the $2.4 trillion pie that happened over the last 10 years. To give you an idea of just how much money that is, the GDP of Canada on a good year is 1.8 trillion. So our total economic output is 1.8 trillion, yet our real estate market is worth more than 3 times that. And it's important to understand that we outperform the US. A lot of people think the US does a lot better than us. I'm not sure where that sort of myth comes from, but the truth is Canada's housing appreciation vastly outpaces the US's when you narrow down to a window of the last 20 or 30 years. Now I'm not going to touch on 2008 too much. I will get into it, but they were hit a little bit harder by 2008 than we were. So the financial crisis took a long time for them to recover from because of loose lending policies that just never really existed in Canada in the first place. So to give you a point of comparison, if in 2005 you bought a property in the US versus in Canada, and this is just your average property, so this is the median price of a home in Canada and the median price of a home in America then and now. And so in Canada it was worth $263,000. If you put $52,000 down on that property, which is 20% down, you would have gained $336,000 as of 2019. So that's 6% year over year. So your 52K would have turned into 336. If you put $47,000 down on a house in the US, the average home would have been $234,000. It would be worth $319 now, and you would have gained about 85 grand. So the difference in appreciation is we're averaging 6% year over the last 15 years, and the US is averaging 2.25. So just, keeping up a little bit better than inflation. Obviously, this isn't true for the problem with looking at median price for Canada versus USA is it's not regional enough, right? Toronto outperforms Calgary and New York outperforms, some places in, I don't know US that well, but I'm sure there are some states outperforming others and some cities outperforming others and vice versa. So we're going to get down to regionally specific, Toronto versus New York type of thing in just a minute here. So it's first important to understand how the housing market works to get a better picture of why we outperform the American market so much. Basically, it all boils down to supply and demand, like most economics in life. And the biggest thing for the demand factor in America and in Canada is immigration. And Canada vastly out-immigrates America, and I'll show you that in a second. So to touch on 2008 first. Here are the mortgage delinquency rates in the United States, 2000 through 2018. You'll notice, a good year is just over 4%. Obviously, in 2008, towards the end of the 2008 financial crisis, up to 10% delinquency, and now they're averaging about 4%. Here's the numbers in Canada. So 4% delinquency in the U.S. In Canada, 0.24%. The delinquency rate in Canada has been well under 1% since the late 90s. So part of the reason for that is, the majority of the reason for that is we have tighter lending policies than the US. In the US, they'll give a mortgage to anybody with a pulse. In Canada, we're very specific about who we give mortgages to, and what that means is we tend to have higher quality mortgages and less defaults. So that's part of the reason we didn't get hit so hard in 2008, and that's also part of the reason why investing in Canadian real estate is just safer in general than investing in in real estate in the States. It's more sheltered from economic fallout. So looking at immigration, this is the number one driving factor behind demand, is population growth, right? And a part of population growth is births, and a part of population growth is your immigration, obviously. So in 2019, the US immigrated 595,000 people. We immigrated 437,000, yet our population is 8 or 9 times smaller than the US population. So our population growth in just immigration terms is 1.1% year over year, where theirs is 0.18%. So we're immigrating about 7 to 8 times faster than the US. And we're building homes 5 times slower. So if you look at actual housing starts, we're only building 208,000 homes. We're only starting to build 208,000 homes in a year where we immigrated 437,000, which, by the way, doesn't include student visas. It doesn't include work visas. This is just PRs and citizenships. So, I mean, it's fairly obvious right there why we why our housing market vastly outperforms the US, because we immigrate as many people for a country 10 times smaller, and then we build 5 times less homes. It doesn't take a rocket scientist to figure out why housing prices are going to appreciate so quickly, because we just don't have enough homes to fill the demand of all of the people moving, in addition to all of the people being born. So, it really does all come down to a function of supply and demand. And the media loves to harp on, let's go back to this really quickly. The media loves to harp on things like speculative investors and foreign and laundered money. That's just media scapegoats. It really does all boil down to immigration. Speculative investment and foreign and laundered money is a problem in the United States as well. It's a problem in any financial asset market, yet we're appreciating at 6% a year and they're appreciating at 2.25% a year. So there's obviously a lot more going on than just the occasional drug dealer buying a condo. And to paint it as such, I mean, the media does such a disservice to the average person by making it seem like the Canadian real estate market is fueled by fentanyl money. It's fueled by immigrants, it's fueled by economic growth, it's fueled by a lack of new home supply. It's certainly not fueled by speculative investment. This is just a closer drill down look of Canada housing completions versus immigration. So if you look at our immigration numbers and you look at our housing completions, just the gap between the two is astounding. On an average year, we're going to immigrate well over 300,000 people, and we're not completing anywhere near enough homes to satisfy the demand. Whereas in the US, the 5-year average is they immigrate 1.175 million and they complete 1.175 million new homes. So they basically build a new home for every immigrant. And in Canada, we're doing considerably less than that. This is the historical and projected population in the Greater Toronto area. And one thing, clients will sometimes say to me is, Jordan, all this immigration is great, but these people, they don't come here with a lot of money and they're not able to buy homes. Well, I work with a lot of them, so I can tell you that that's not true. A lot of them come with a lot of money. They're very skilled people who come here to work specific jobs. They come here for the opportunity first and foremost. So a lot of them bring quite a considerable amount of money, and they do buy. So within 5 years of coming to Canada, 29% of them buy and 56% of them rent. And it's important to note that even if somebody rents, what they're doing is they're eating up rental supply, which drives up rental rates, which in turn makes it more profitable to invest, so more people purchase investment properties. So whether they rent or buy is irrelevant. If they're coming here and they're living here and they're staying here, then they're adding to the demand for the housing market. Annual change in population. So it's important to note also that most of our immigration comes to Canada, an overwhelming percentage. So if you look at the absolute change in 2019, we gained 531,000 people. Half of that, 248,000, came to Ontario. A small chunk went to British Columbia, and the rest is kind of scattered around. Montreal is seeing a population boom, Ottawa as well. Here's the cities in North America with the most amount of growth. So the Greater Toronto Area, this was 2018, by the way. 2019, we actually saw higher numbers than this. But in 2018, the Greater Toronto Area gained 125,000 people. That's after accounting for people leaving Toronto. So you take your net migration minus all of the people who moved out of the city, and you get 125,000. Same for Toronto. So for Toronto alone, Toronto postal codes, you get 77,500 people. And if you look at a place like New York, they're actually losing people year over year. So New York is actually losing population. There's a number of reasons for this. Cost of living is one of them. So it's important to note that the Greater Toronto Area is in a pretty unique position where it's getting the lion's share of the immigration in Canada, and we're just in a scenario where we can't build homes quick enough. We have the green belt, which sort of landlocks us, doesn't give us the opportunity to build as much housing as we need, and then we've got things like city planning and government really weighing down on our housing supply. Just to kind of test our theory, does population growth or population shrinkage result in different results in the housing market? We're going to look at some actual comps. So we know the U.S. averages between 2 and 3% appreciation a year, and the Canadian market averages about 6% a year. So we're going to look at some specific examples from specific cities to get a better idea of what cities are performing incredibly well. So we're going to start off with New York City. So this unit here, 255 Hudson, I picked this unit because it's right on the border of Soho and Tribeca. It's like the Yorkville of New York there. This is a building that's been around for some time. It's a boutique condo building. I'm going to ignore the fact that it sold for more in 2006 than 2011 because I want to leave 2008 out of our equation because the US was hit harder than us. So we're just going to look at the 2011 numbers. So in 2011, it sold for 1.1 million, and then it sold this year in 2020 for 1.4 million. So that it's increased roughly 30% in value, or 2.72% year over year, which roughly lines up with the US's average at 2.25 to 3% year over year. And just to give you a point of comparison, this is a 1 bed, 1 bath, 917 square foot in an older building, and I don't think this, it looks like it was renovated, but either way, 917 square foot, 1 bed, 1 bath, sold for 1.4 million US. So that's 1,526 per square foot US, which translates to about $2,000 a foot Canadian, which is just unbelievable. We'll be there soon, don't get me wrong. Toronto will be there within the next 10 years. But here's another unit in New York. This is 330 Spring. This is also in Soho. This one sold for 1.675 million in 2011, and then it sold for 2.31 million in 2020. Again, right around that 1,500 per square foot mark in US dollars. So this one appreciated a little bit. This one did a little bit better than a lot of the listings I checked in New York. This one averaged 3.64% year over year. The New York market it's a heavily buyer-sided market. They have 8 to 10 months of inventory depending on when you're looking. So they have more sellers than buyers. So it's not like a Toronto situation where we have way more buyers than sellers. They're firmly in buyer market category and have been for a number of years. Okay, San Francisco. So here's a listing in the Bay Area, the financial district of the Bay Area, one of the most expensive and highly desired neighborhoods in the Bay Area. This one sold for $615,000 in 2009, and then it sold for $829,000 in 2020, which translates to about 3% year over year. Here's another listing, 733 Front Street. This one sold, again, we're going to ignore the fact that it sold for more in 2017 or 2007 than it did in 2010, because I want to leave 2008 and the financial crisis out of the equation here and give kind of an apples to apples comparison. So in 2010, it sold for $840,000, and then it sold again in 2020 for $1.425 million. So this one averaged, 5.4% year over year, which is, out of a lot of the listings I checked in San Francisco and New York, one of the highest performing ones. Okay, Toronto. Here's a listing in Toronto at 4,000 Spadina in City Place. So this is your average, one bedroom apartment, unit 805. This one just sold for $550,000. So it was purchased in 2011 for $268,000, and it was sold for $550,000, which means it appreciated at 8.32% year over year. 8.32%. Which is more than double New York or San Francisco for the most part. Here's another one, unit 514 at One Shaw, DNA condos. This is in King West. This listing's in City Place. This listing's in King West. This one was purchased in 2010 for $300,000. It was then sold in towards the end of 2019 for $561,500. So that's 7.2% appreciation year over year. And here's another one at DNA. So again in King West, this one was purchased in 2011 at $383,000, and it was sold in 2019 for $695,000, representing a 7.7% appreciation year over year, which is just, again, astounding. Somebody they bought it for $383,000. They probably put like $40K down, and then they sold it for $300,000 more than they purchased it just 9 short years later. So that goes to show you the power of leverage. So some people ask me, why don't I just put my money in the stock market? And there's a number of reasons why. The leverage is one of them. Another one is just stability. The housing market is more stable. You don't have the type of sharp downturns that you do in the stock market. And in Toronto, the average appreciation over the last 15, 20 years, about 7% year over year, which roughly is the same as the S&P 500. The big difference being you only have to put 20% down on a condo. So just to give you a point of comparison, if you had $73,000 to invest in April of 2015 and you put it into the S&P 500, that would have been worth at February's highs. So I'm not taking into account COVID at all. Let's say you sold it in February at the all-time high for the stock market because you're a genius and you avoided the crash. You would have turned that $73,000 into $118,000. So you would have made $45K in about 5 years time, or exactly 5 years time, which is a great return on your money. It's been one of the best bull markets for the S&P 500 in a long, long time. But if you took that same $73,000 and you put that $73,000 as 20% down on a $365,000 investment, one bedroom condo downtown Toronto, that unit would be worth $641,000 as of April's market lows. So taking into account COVID, where we saw $20,000 to $30,000 price decrease on condos, assuming you sold it at the bottom, because the market has, this graph I did about a month ago, the market has actually rebounded since. But if you were to sell it then for $641,000, you would have made $276,000 on your money rather than the 45. And this is just, again, the power of leverage, right? You're putting 20% down to own the full asset. So you're controlling $500,000 worth of an asset with only $100,000. It's just not possible in the stock market. Here's an actual real life example of the power of leverage. So there was a client of mine purchased a $295,000 one bedroom in King West. He bought it back in 2010. 20% down on that unit was $59,000. It was a pre-construction unit. He closed on it in 2014. There's about 10 grand in closing costs. I won't get too specific with this. Basically, in 2019, it was worth $596,000. Which gives him roughly $301,000 in equity gain. So he made $300K on his investment of 60 grand. And in addition to that, there's some principal pay down on his mortgage because his tenant was paying his mortgage. And there's $18,000 in cash flow because the rent was actually higher than all of his monthly outgoing expenses. But I won't get into that in too much detail. I just want to show you, again, you turn $60,000 into $345,000 in roughly 10 years. Just by leveraging the property market and allowing a tenant to essentially pay your mortgage down. Let me leave you with one final thought here. This is a quote from Andrew Carnegie. 90% of all millionaires become so through owning real estate. And we saw proof of that in the very first or second slide. Most Canadian households are comprised, their wealth is comprised, the majority of it from real estate investments. More money has been made in real estate than in all industrial investments combined. Again, proven with the GDP versus the value gain in real estate. The wise young man or wage earner of today invests his money in real estate. It's not easy to get into the market, especially in places like Toronto. If you are a first-time buyer and you're looking to invest in the market, the number one piece of advice I can give you is just get in sooner rather than later, even if that means getting into a less desirable property. So if you're renting a one-bedroom downtown for $2,500 that you love, but you could afford a $400,000 condo on the outskirts of town in Etobicoke or Mississauga, just bite the bullet and get into the market. Because here's the thing, when this happens, let's say you make $45,000 on a stock investment. The only way to access that wealth is to cash out of your stock portfolio and take that cash. In real estate, there's a better way to do that. So if you take your if you put $60,000 down on a $300,000 condo and it's now worth about $600,000, you can go to the bank and get a loan for the difference and take that money and reinvest it into another condo. You don't actually have to cash out of your investment. You don't actually have to liquidate your asset, which, in Canada, where we live, liquidating your asset just incurs a ton of transactional fees. You've got your realtor fees, your lawyer fees, and of course the big ticket item, your capital gains tax, because as it turns out, free healthcare isn't all that free after all. So the best case scenario is to hold assets as long as physically possible, refinance it, and leverage that wealth to get you in other assets, ideally real estate. And that's how the game is played. That's why we have so many millionaires in Canada. It's really not that hard to achieve. The hardest property is always the first one, because it means you got to save the down payment. From there on out, you can just leverage existing properties to double or triple up on your investment real estate, and that's when things get really easy, and that's when the snowball effect takes over, and before you know it, you're retiring 5-10 years early. Okay, so that's it, guys. If you have any questions, if you want to know about specific investments, where should I invest, where should I not invest, I have more videos up on my channel. I've got more videos coming out. You can also just shoot me an email anytime, jordan@precondo.ca. I'll put it up here on the video, and hit the like button and leave a comment if you've got any questions, and I'll get back to you.